Hello everyone. What an action-packed month for Indian equities. After 8 straight sessions of weakness, the markets finally found their footing in first week of October and did it with conviction. The spark came from policy stability. The RBI held rates at 5.5% with a neutral stance, a quiet vote of confidence that steadied sentiment. Just days prior to that came GST 2.0, a reform promising simpler compliance and sharper transparency. The real test though lies in sustaining the initial consumption momentum. The primary market stayed lively. Tata Capital, LG Electronics India and Canara Robeco AMC are all lining up for IPOs. That tells you one thing, domestic liquidity isn't blinking. It's still betting on India's next growth chapter. Now, as Q2 FY25 earnings begin, expectations are measured. This quarter could mark the bottom for Nifty EPS growth. If festive demand and cost discipline align, growth and margins may bounce back sooner than most forecasts suggest. On the global front, worries around a US government shutdown and ongoing trade tariff talks have added uncertainty to global risk sentiment. A reminder that foreign flows remain sensitive to global cues. Foreign investors stayed net sellers, while domestic institutions kept absorbing the flow. Foreign money may hesitate, but local conviction clearly isn't flinching. So policy stability at home, reforms in motion, and global uncertainty abroad. That's the market's current rhythm. The next few weeks will reveal whether this rebound becomes momentum or just a breather before results season. That's it from the equity side.
Two key developments shaped sentiment in the fixed income market. First, the government's borrowing plan for the second half of financial year 2026 was pegged at INR 6.77 trillion and came with a smart adjustment. Issuance in the 30 to 50 year segment has been cut by 5%, while supply in the 3, 5 and 10 year tenures increased. It's a measured shift, easing long end pressure and thus saw longer end yields easing by 10 bips. Second, the RBI's MPC held the repo rate steady at 5.5%, but the tone turned dovish, leaving policy space open. Growth for financial year 2026 was revised upward to 6.8%, but the second half was trimmed slightly to 6.3%. Inflation projection for financial year 2026 were lowered to 2.6%, while financial year 2027 edged higher to 4.5% on base effects. On the yield curve, the flattening trend we spoke about in our earlier commentary has started to take shape. We expect the 10-year GSEC to remain between 6.4 and 6.6% in the near term. Our outlook stays firm. A 25 bips rate cut in the second half looks likely, which could further ease yields and maintain the flattening bias. So, with a steady policy, balanced supply and easing inflation, the bond market remains quite confident. Thank you and happy Diwali.